You know that feeling when you check the silver spot price and think, okay, I'll finally grab a few ounces today, and then the dealer hits you with two words that don't even sound real in a market that's supposed to have a price. No quote. Not out of stock. Not premium is higher, just no quote. And if that's happening in more than one place at the same time, it's not a random inconvenience. It's a signal the physical market is under stress, even if the screen price still looks calm. If you want simple story-style updates that explain what these signals actually mean for people in the US, take 1 second to subscribe. I keep the language clear, I connect the dots, and I focus on real-world clues you can actually observe, like premiums, spreads, and availability, not just dramatic headlines. Subscribing helps you stay ahead of the story while it's still forming. Now let's talk about what no quote really is, because most people misunderstand it. A quote is a promise. It's the dealer saying, I will sell this to you at this price right now, or I will buy this from you at this price right now. When a dealer says no quote, they're telling you something without saying it directly. They don't trust they can replace inventory at a predictable cost, or they don't trust the wholesale market is stable enough to lock in a price without taking a hit. Think about it like this. Imagine you run a store that sells a product you normally restock easily. You're comfortable putting a price tag on it because tomorrow you can order more at roughly the same cost. But then the supply chain gets weird. Your supplier starts changing prices every hour. Shipping timelines become uncertain. Customers suddenly rush in at the same time. If you keep selling at the old price, you might sell out fast and then discover you can't replace what you sold without losing money. In that moment, the smartest business move isn't to guess a new price. It's to pause and say, no quote, I need to confirm my replacement cost first. That's exactly what's happening in pockets of the physical silver market. And here's why it matters. When no quote spreads, it means the stress is not isolated to one shop having a bad day. It suggests the replacement risk is rising across the dealer network, or the wholesale pipeline is unstable, or the demand wave is coming in faster than inventory can be replenished. In other words, it's a sign the market is clearing through friction instead of clearing smoothly through price. This is where people in the US get tripped up, because we're trained to believe the spot price is the price. But spot is mainly a paper reference price, heavily influenced by futures and other forms of financial trading that can change hands instantly. Physical silver is not instant. Physical silver is a real supply chain, mined, refined, minted, shipped, insured, verified, and delivered. Those two worlds usually stay close enough that nobody notices the difference. But when stress builds, paper can keep printing a number while physical starts behaving like that number isn't a real clearing price anymore. That's why you'll see strange contradictions during stressed periods. Spot might dip, but physical premium stays stubborn. Spot might rise, but dealers widen spreads. Spot might look stable, but suddenly you're seeing call for pricing, minimum order rules, limited quantities, or no quote altogether. Those aren't just annoyances, they're signals about the real-world pipeline. Now, let me tell you the most common reason no quote spreads, and it's simpler than most people expect. Volatility. When silver moves fast, dealers are caught between two risks at once. If they sell you metal and the paper price jumps again before they can restock, they may have to pay much more to replace it. If they buy from you and the paper price drops sharply before they can hedge or resell, they can get hit on the downside. Dealers can hedge some risk, but hedging is not free, and in extreme moves, the spreads and slippage get worse. So instead of making a bad promise, they pause. The second reason is wholesaler uncertainty. A lot of retail dealers depend on wholesalers and mints. When wholesalers reprice rapidly or can't confirm ship dates, the retail layer can't confidently quote you a final price with normal terms. This is why you sometimes see a website showing prices but not letting you check out, or a local shop telling you to call back in an hour, or an online dealer switching to call for pricing. It's not always because silver is gone. It's often because upstream pricing is moving too fast to lock. The third reason is physical tightness in specific products. Not all silver is equal in the real world. The market can be fine in one category and tight in another. 1 ounce coins can vanish while larger bars are still available. Certain government minted coins can get tight faster than generic rounds. If the popular products get hit with a demand wave, dealers don't want to sell what they can't easily replace, especially during a spike. That's how you end up with no quote, even though silver exists somewhere. It's about form, location, and speed. Now, there's a question I know you're thinking, and it's the right question. If the market is efficient, shouldn't higher demand just push the price up until supply shows up? Sometimes, yes. But markets don't always solve tightness instantly through the spot price. Sometimes they solve it through terms. Premiums rise, spreads widen. Delivery times stretch, minimum orders appear, purchase limits return, and in the most stressed moments, quotes disappear. That's the market saying, the paper number is not enough to make physical trade smoothly right now. This is also why people talk about paper silver versus physical silver. Paper can absorb demand as contracts. Physical must absorb demand as metal moving through real bottlenecks. Paper can look liquid and calm even when physical is tight. And physical can stay tight even after the paper price calms down. That last part is the one to watch, because it tells you whether this is just a volatility storm or a deeper supply and demand pressure. Here's a simple reality test you can use, especially if you're in the US and you buy physical. After a chaotic day, does the physical market loosen quickly or stay tight? If spot dips and within a couple days premiums come down, inventory refills, and dealers quote normally again, then the stress was likely temporary. But if spot dips in physical still doesn't get meaningfully cheaper, availability stays thin, spreads stay wide, and no quote keeps showing up, then the pressure is still inside the system. That's when people start saying the real price is higher than the screen suggests. Now, I want to keep this grounded and not turn it into panic content. No quote is a signal, not a prophecy. It doesn't automatically mean silver is about to explode tomorrow. It doesn't automatically mean there's a permanent shortage. It means the market-making function is stepping back, and when market makers step back, the terms of trade change. That is always worth paying attention to. This is also why no quote can spread quickly. Dealers watch each other. Wholesalers influence everyone. When one layer pauses, the next layer gets cautious. And the faster the market moves, the more cautious people become, because nobody wants to be the person who sells too cheap or buys too high during a price whipsaw. In real life, the market doesn't break in one dramatic moment. It breaks in behavior changes that ripple outward. Now, let's talk about what you should watch next, because this is where the story gets interesting. The silver market often gives you clues before it gives you headlines. One clue is premiums. If premiums are rising while spot is stable, physical demand is firm or supply is tight. Another clue is the buy-sell spread. If spreads widen, uncertainty is rising. Another clue is delivery time. If delivery times stretch, the pipeline is congested. And another clue is dealer behavior. When you see limit 2 per customer, $500 minimum order, call for pricing, or no quote, those are not random. Those are stress responses. And there's a global angle too. Sometimes you'll see hints of physical demand pressure through regional pricing differences, like when major hubs trade at different effective prices. Those gaps don't always matter, but when they persist, they can signal real demand pulling on supply chains. Real metal movement has friction, and in stressed markets, friction becomes the whole story. So what happens next from here? There are usually 3 broad paths, and I want you to keep these in your mind because they help you stay calm and stop doom scrolling. One path is the fade. Volatility cools off, wholesalers reopen normal terms, dealers start quoting again, premiums relax, and this becomes a short-lived episode. The second path is repricing. Dealers start quoting again, but at higher premiums and wider spreads because they're acknowledging replacement risk and tighter supply. Spot may follow later, or spot may chop while physical stays expensive. The third path is the messy split. Paper continues trading a clean number, but physical stays hard to source at normal terms. No quote comes and goes in waves. Premiums remain stubborn. Certain products stay thin. The market still functions, but it functions with 2 realities, a reference price and a physical transaction price. Which path we're in becomes clearer after the initial shock. The market always looks craziest at the peak emotion. The real signal is what happens after emotions cool. Do dealers reopen confidently, or do they stay defensive? Now, one more important point for US viewers, because this is where people get emotionally trapped. When you see no quote, your brain wants to react fast. Some people chase because they're afraid of missing out. Some people panic sell because they're afraid it's the top. But the hidden risk in a no quote environment is execution. Spreads and premiums can swing wildly. You can be right about silver long-term and still lose money short-term by transacting at terrible terms during peak chaos. This is why understanding the signal matters more than reacting to it. So here's what I want you to do with this information right now. Don't just watch the silver chart. Watch the real-world terms. Watch premiums, spreads, and availability. Those 3 will tell you whether no quote was just a volatility pause or a sign physical is staying tight. And now I want to hear from you because your on-the-ground experience is part of the data. In the comments, tell me what you're seeing where you live in the US. Have you seen call for pricing or no quote recently? If you tried to buy, what did you notice about premiums and delivery time? Coins, rounds, or bars? Also, if this video gave you clarity, please share it with one friend who still thinks silver has one simple price on a screen. Sharing helps more than you think because it brings people into the conversation before the headlines get dramatic. And here's the final takeaway. When no quote starts spreading, it's not just an inconvenience. It's the physical market quietly telling you that pricing is unstable at street level, replacement risk is rising, and the paper reference price may not be clearing real supply smoothly in that moment. Stay calm, watch the follow-through, and focus on behavior, not hype.